Chapter summary for tangible non-current assets. So quite a big chapter in this syllabus. Lots of lovely stuff to learn about tangible non-current assets. Let's go through each of the elements in turn. So looking at IAS 16, which governs property, plant and equipment, a lot of the stuff that's in this standard you've covered already in your previous studies. So things like when we recognise an asset, how we measure an asset, how we depreciate an asset, all covered in your previous studies, but when you're going to be looking at subsequent treatment or looking at the sort of more intricacies of things like revaluations, we're going to be recapping things like disposals and depreciation as part of that. So if you're uncomfortable at all, you can go and look at the essential reading and recap some of the assumed knowledge in there, or you can pick it up and refresh as you're doing some of the more tricky bits, the new bits for this paper. So looking at accounting for revaluations, what would normally happen if you had an upwards revaluation, so you had a property that used to be worth £1 million and then it goes up to £1.2 million, you would pop through a debit to increase the value of my asset, my PPE, and the credit will generally end up going through other comprehensive income, ultimately landing in a revaluation surplus. So instead of going through the P&L and into retained earnings, it goes through other comprehensive income and lands in a revaluation surplus. What you've got to watch for is what has happened in the past. So really careful, or it's really important that you are careful in this exam and look at all the information you've been given, particularly if you've been given information about previous years and previous revaluations that might have taken place. If there was a revaluation in a prior year where there was a decrease in value which went to the P&L, then what we would have to do is reverse that decrease first by putting it to the P&L and then putting the rest to other comprehensive income. So being really careful that we eliminate any downwards movement that has previously been recognised. If we've got a revaluation decrease, what will happen is my property will go down in value. So you would do a credit to reduce PPE. And again, in another straightforward situation, all that you would do is debit other comprehensive income or revaluation surplus if a surplus exists. So if in the past there has been revaluations upwards and then they've seen a revaluation downwards, we can remove or reduce the surplus. However, if there's not a surplus first, that debit goes straight to profit and loss. And it's an example of prudence where we recognise losses earlier than we recognise potential gains. So the debit would go to revaluation surplus, if there is one, or profit or loss account, if not. We'll take that loss now. So really careful on what's happened in the past, think it through, take it step by step, year by year, and do nice clear workings for these accountings for revaluations. Revalued assets are also depreciated, so this is where you're going to get your recap of depreciation as well. What you've got to be careful again is when is the revaluation happening? Is it happening at the beginning of the year? Is it happening at the middle of the year? Or is it happening at the end of the year? If the revaluation is at the start of the year, then what we would do is we would revalue it at the start of the year, then we would depreciate it on the new revalued amount. However, if it's at the end of the year, then what we would do is we would depreciate based on the old cost, then revalue, and then we've got no further depreciation to do until the following year. So you've got to be really careful with the dates you're given in the exam. And then the third situation is when it might be mid-year, in which we've got to prorate, and we depreciate based on the old amount up until the revaluation point, revalue, and then depreciate based on the new revalued amount. Super, super, super careful with your dates in these questions, please. Complex assets are assets which consist of a bunch of different parts, different components. It's just really saying that we can treat them as separate assets. For example, a plane the seats, our interiors, the engines. We treat those as 3 different assets with 3 different useful lives, and when we overhaul them, then we would just dispose of them and recognise the new ones. And that's all we're talking about there. So that's IAS 16. We learnt about a new standard, IAS 40, which is all about investment properties. So investment properties are different from PPE, so it's not an HQ. Owner-occupied is not investment property, it's PPE. Investment property is different. Investment property is property that's held to earn rentals or for capital appreciation. So it's purposely held for investment purposes. So because of that, we treat it slightly different in that we recognise the gains and losses essentially straight away, because it is being held to recognise gains and losses. Hopefully gains, but also losses. There's some definitions here which should be familiar. And recognition criteria, again, familiar. We recognise it when probable economic benefits will flow to the entity and the costs can be reliably measured, coming from the old conceptual framework and written into the standard. We initially measure it exactly the same way as we would any other property. However, subsequent measurement, we've got a choice. We will elect, and we can choose either the cost model or the fair value model. Now, the fair value model is a bit similar to the revaluation model, but it's not the same, so really careful that you don't get them muddled up. With the fair value model, what you do is you measure at fair value at the end of each reporting period. The gain or loss goes to the P&L. There's no revaluation surplus. We recognise the gains and losses straight away. And because we're not holding it for use, we are not depreciating either. So 3 key features of the treatment of investment properties that makes it quite different from a headquarters or a factory that might be a normal piece of property, plant and equipment held by a company. What happens with investment property is it might move about. It might be that they've got an HQ and then they decide to rent it out, for example. So it could be that you've got some PPE that moves to become investment property. And it's just, again, being really careful with dates. So up until the date of transfer, we treat it under IAS 16. We treat it as a bit of property, plant and equipment, and we depreciate as normal. But at the date of transfer, what we do is we revalue it to fair value, and then it becomes investment property. And we go back up to the top bit here where we measure at fair value at the end of each reporting period, gains or losses to the P&L, and no depreciation. Similarly, we might decide to sell that property. That investment property becomes sort of inventory rather than held for long term, in which case all we're going to do is treat it as investment property right up to the date of the transfer, and then after that it becomes inventory, and we treat it as if it was inventory. At the point of transfer for both of those scenarios, we are going to revalue it to its fair value. Disposals, any gain or loss is recognised in the P&L because that's what we've done with these investment properties to date. Any gains or losses have always gone to the P&L. And just be aware of disclosures. Don't get too bogged down in them. You might get a short form question, for example, on a disclosure, but they're not going to be the bulk of this exam. So just an awareness of the sorts of disclosures you need for these elements. The last bit of this chapter is on borrowing costs, so IAS 23. Borrowing costs is really talking about the costs in relation to borrowing. Borrowing being a loan and the cost of a loan being the finance cost or interest expense. So what we're talking about here is loan interest, or in the accounting world we talk about that as being a finance cost, aka a finance cost. So why are we talking about loans and finance costs when we're talking about assets? Well, when we capitalise an asset, we can include any costs related to that asset that were necessarily incurred to make that asset ready for use. So as part of that, certain qualifying assets can capitalise borrowing costs. So what is a qualifying asset? A qualifying asset is one that necessarily takes a long period of time to be ready for its intended use or sale. So nice examples of these might be something like a bridge or a stadium. Take a long time to build, and the company might take out a loan to help them build that. So what we're saying here is that instead of debiting finance costs, they can debit the asset instead. Now, they can't just debit all of it. We've got to be really careful what we can. So there's certain bits you need to be aware of. Firstly, it depends what type of borrowing they have done. So if the funds have been specifically borrowed, so if they have borrowed £10 million just for that bridge, then they could capitalise the interest in relation to those borrowings, less any income. So imagine, for example, they took that £10 million, but they only spent £5 million in the first year, and they spent £5 million later on down the line, but they perhaps invested it and made a little bit of investment income. We'd have to net that off, so you wouldn't get to include that. So a little techie bit there just to be aware of. That's if they've specifically borrowed funds for that asset, or they might have just borrowed funds for the company in general. So maybe they've borrowed £50 million, and of that £50 million, they're going to allocate £10 million to the bridge or stadium, in which case you need to capitalise the weighted average borrowing costs in the period. So two things are to be aware of when we're looking at what we're going to capitalise. Another thing to think about is that we can't just keep capitalising forever. So when do we start and when do we finish? So looking at a timeline, we would start when commence capitalisation, when expenditures incurred, borrowing costs incurred, and activities are started. So for example, we start to build. And we stop when it's ready for use. And so what we're really talking about here is that before they've started building, if they've already started incurring some costs, then they don't get to capitalise them. They're just going to debit finance costs, you also might know as interest expense, and credit the loan if we're accruing it, or credit cash if we're paying it. Then what might happen is, say there is a problem and for a short period they've had to stop working. Maybe there's a strike, maybe there's a supply issue. Then also what we've got to be aware of is in this period here, we're also going to debit finance costs. So before, and when they stop, and after, we're going to debit finance cost. However, in these periods here, what we get to do is debit the asset, or our PPE, instead. So it's nice, we're showing an asset instead of an expense because it is the cost related to that asset. Let's not do that the same colour. So in these periods here, what we can do is debit that asset instead of debiting an expense. So lots of little bits in there that you just need to be mindful of, but overall, if you do see something in the exam, they will sort of mention that it is something big like a bridge or a stadium, that they've taken out a loan. You have to capitalise the finance costs, but make sure that you're only capitalising it for the number of months here. So say that was 3 months, say that was 2 months, then how much are you going to capitalise? You would capitalise 5 months worth of borrowing costs or finance costs, and the rest just goes to finance costs expense as normal. So a big meaty chapter, this one. This will come up in your exam, not borrowing costs necessarily, but anything from our revaluations, our standard PPE, our investment properties and our borrowing costs, very, very examinable. It will come up for lots of marks. So make sure you just do lots and lots and lots of question practice with these. And you've seen the importance of just being really careful with the information you're given and the dates that you're given, and just take everything really systematically with lots of lovely clear workings, and you'll do really good in this area.